Hi everybody, this is Gary Dean and this is our weekend video report for Sunday, April 24th, 2016. I hope you guys are having a fantastic weekend and let's get started. So Friday kind of had that look and feel like things were going to break down, and then we really saw the Dow try to pick things up, and it really looked like they were just trying to close it at 18,000, and they were throwing everything out to keep it there. NASDAQ got absolutely crushed, and I really think the NASDAQ is something that we really want to pay attention to, because out of all the markets, out of the S&P and the Dow, the NASDAQ just made it right up to the 78% retracement, which I'll show you in the other charts, but it was really breaking down on Friday, and I think that's going to be the drag on the markets. But in any case, just looking at the internals, the advanced decline still at highest levels we've ever seen. Doesn't really seem like there's that much more gas in the tank, but I've been saying that, and it keeps going higher. But in any case, it's just it's not a safe area when it's at here. You want to be looking to buy when you have the advanced decline in these areas. So you're looking to pick a bottom, and when it's up to these levels, you want to start looking for a top. Obviously, it's gone even higher than that, but it doesn't make things safe as far as just being complacent on the long side. So if we take a look at the VIX, and again, this is the chart that if you were bullish on the markets, you would be probably the most concerned with, because again, we have the VIX that's at support and you have the S&P that's at resistance, and we do have bullish divergences on the VIX, and what it's implying is that we're probably going to see some type of volatility hit the market, and it wouldn't surprise me if that happens, next week sometime. Taking a look at the put call ratio, again, you can see this was when the low was made on the for the actual what is this technical indicator for the VIX, and we know that the S&P had continued higher. So I meant, this isn't the VIX, the put call ratio, and you can see that this is not made any type of lower low, but you have the S&P that's making higher highs. So it's a bearish divergence for the markets. If we take a look at the S&P bullish percent, again, we're in areas where you want to actually be looking for some type of top, not looking to buy. You want to be buying when it's down here and looking for support levels. So again, it's at areas that it's just not safe to be complacent on the long side. So let's take a look at our regular charts and go over what we're seeing there. So this is the Dow Jones, and this is the 60-minute chart. Again, these divergences have been taking place ever since going all the way back to February 17th. So this is a long drag of bearish divergences without the Dow ever getting any kind of in oversold levels at all. So there's really been no breather during this move right here, and you can see we're trying to form yet another bearish wedge. Each time we've had those and they've broke, what happened, it went sideways and then popped up. So here we're looking like we're going to be trying to break this wedge again, and eventually one of these aren't just going to go sideways. You're going to see it actually see some kind of price reaction to it, and a typical move after these types of divergences would be a 50%, 62, or 78% retracement. So we're looking 16.821, 16.5, and then all the way down to 16,000 would be the targets for the Dow. This is what I was talking about with the Qs here, or technology. This move made it right up to the 78% retracement, almost to the penny. It did come down and touch the moving average, and then we had a rally back up a little bit, but it's still closed down 1.5%. And I believe that the rally was just because we didn't really see the S&P or the Dow breaking down, and that we just had some shorts that started covering. But this is the important part, because we have the bearish divergences, we're overbought, made it to the 78% retracement, which is typically a retracement level before things break back down again. And, we saw a big move down on Friday that could have been a lot worse than where it actually was. So looking at the S&P here on the daily, again, we have the bearish divergences, very overbought. We have 5 waves up where you have 1, 2, this is 3, 4, 5. So what this implies is that, since we have the 5 waves up, a typical retracement would be down to the 1960, 1925, or even the 1974 level. So we're at resistance. You can see the moving averages are starting to cross. So I would say, being on a conservative side, that a bare minimum move would be take the S&P down to the 2017 level. But like I said, because of the extension of this move and no real breathers whatsoever, it would actually make more sense to do a 50, 62, or 78% retracement, and these would be the targets. Looking at the 60-minute chart, again, very similar to with the Dow. These bearish divergences have been taking place since the 17th here. We've never made it into deeply oversold levels, so there's been no breathers. And it's trading within the same type of bearish rising wedge. Now, this is what I was saying, the first level of, where things may be starting to break down a little bit, would be a break of the 2077 level. We didn't get there, and then we got a little bit of a rally, and the S&P closed unchanged, but it was down some 9 points or something at one point. So things are getting very, very tired. I do believe that if this level gets taken out, there's going to be a reaction trade down to the 2058 and more likely down to the 2033 level or the 2040. But remember, if we're just going to do a 23% retracement, 2040 would be the target. A 38% retracement would be 1996. But as I said, with the amount of time that this has taken and the bearish divergences that have been continuing to mount, I believe that a larger than a 23 or 38% retracement would be coming. So that's pretty much it. On the 15-minute chart here, you can see that we broke this wedge that I pointed out on Thursday. This is just the shortest term where we had the 5 waves. You can see the moving averages are starting to cross here. Now, we haven't seen that since going all the way back to April 6th. But it did hold support at the 2081. So what the bears need to do is really hold it below the 2103. If they don't, then most likely we're coming up to test or even break these 2011. If they take these lows out, most likely there's going to be a reaction trade down to the 2072. But like I said, if we go below the 2072, that's breaking the support, and most likely we're going to see 2058 or even 2040. So right now, things really haven't changed all that much. They're very, very overextended. They're looking tired right now. The VIX is at support. The S&P and just about all the other indexes are at resistance, and I think it's just more of a matter of time before we see some kind of break to this this bullishness that we've seen in the market, and a deeper retracement would be at hand. So with that, enjoy the rest of your weekend. Let's see what plays out tomorrow, and have a great day.